Sarah Weaver is in the back there. I know we don't have a ton of people today, but she's going to do a book signing on this end table a little bit later. She's doing a coaching class right now that she's hosting, and she's doing it from the lobby. And so she'll be over here, and she'll be signing books. So if you want a book, you can get signed, and she should have something to sell. But thank you guys for coming out. My name's Ted. I run the Omaha REIA with my wife Jessica at the front desk. We knew the snow was going to keep us a little light today, so I appreciate you guys venturing out. A couple shout-outs and announcements we'd like to get out before we get going here. This month's sponsor is Liquid Lending, so thank you to Owen Dasher and Colin Schwartz for sponsoring tonight's events. We couldn't do this without you guys. And our drink sponsor is DBG Realty. What that means is after the event, we go over to Burger Theory, which is in the same building right next door. Your membership card will get you 25% off anything you eat, and then DBG is taking care of the first round of drinks. Not a lot of people here, so you probably get more than one or two. So take advantage of that. And then, of course, we got those 2 book giveaways. What we ask is if you read a book, you love it, bring it back, put your card in there, and we recycle. So that's one thing we like doing. So if you bring it back, just put your card in it, put it over there on the table, and we'll include it in the drawing. If you guys are a fan of our podcast, REIA Radio, we have Trevor Shade that just dropped last week. Part 2 drops tomorrow. Great story and all about systems. It was a fun podcast to record. We've done this. We have Bob Fishbein coming up. He's with J. Real Estate Capital. We have Shelby Johnson coming up. Shelby runs one of the biggest, most successful real estate teams in all of the Carolinas, north and south. She also has about 40, 50 properties. She's been featured in every major real estate podcast, and she has a national meetup group that she started, some Brews and Brews. You remember what it's called? Yeah, Drinks and Brews or something like that. We got Tamar Hemies, JD Luma, Sarah Weaver for second interview, David Dodge, Alex Camacho, Justin Cambria, Ashley Kerr, and Mark Simpson. So lots of good names coming up. We've been doing a lot of recording, so stay tuned. If you guys like what you hear with that, please give us a review on our podcast form. We really appreciate it. And thank you to the staff at the Holiday Inn. Thanks for making the drive. And if the girl said that instead of getting them tips, you can just write them, give them reviews on their QR code tonight. Is that what you were saying over there, Jenny and Kelly? And then make sure you drop Jenny and Kelly are the best, because they're the main reasons we keep on coming back here. They take good care of us. So appreciate it. If you do start a tab here, you can take it over to Burger Theory after the event too, so you don't have to pay it here, just so you guys know. A couple upcoming events. Obviously, we have Jordan Downey tonight. We have the Omaha REIA Luncheon at the Railcar Cafe, and that's going to be Friday, January 19th, 11 to 1. Everybody's welcome, members and non-members. And then also, if you are a member of REIA, you're part of National REIA, and the National REIA Zoom call is Friday, January 19th, also 4 p.m. So you go to omahareia.com, go to the calendar, register for that. They should be sending you emails for that also. But there's usually several hundred people on those calls, and then they have a national speaker, and then they also have a couple of the national sponsors, which are the benefits that you get. And then we are doing the Oxford House Model Program, Transforming Lives, and Ken Norman, he runs the local Oxford group. If you, there's a couple people that handle the Oxford. If you do Oxford in the room, can you raise your hand? I see 2 people. And so, bye, Jessica. She's waving. She's sneaking out there. But it's a great program. It's sober living homes. They're throughout the whole state of Nebraska, and it's just a new way of looking at investing. They like to rent the properties sometimes for up to 20 years. They take care of the repairs under $100, and they manage it for you. If they'll take care of the lawn, they'll take care of the snow removal, and so on. So it's a great program. It's something I've personally been looking into. I've showed them a couple houses, and I've not gotten one approved yet. They're very specific on the areas. If it's in a bigger city, they're a little bit more open than when you get outside the bigger cities. So definitely check that out. And so that'll be on February 6th. And March 5th, we are bringing in Jeff Holst. And he's the author and investor. He wrote the book called No Bad Days. I originally met him at the Bigger Pockets Conference when I was in New Orleans. And we had a great time with him. The next day after that, he was on the MVP podcast. He blew up after that. And he has a podcast called Old Fashioned Real Estate, which is my kind of real estate talk right there. So we've had him on our podcast. I don't remember the episode number off the top of my head. I probably should know that, but probably in the 60s or 70s, right, Dunless? And we'll put that link on our Facebook channel. But great guy. He's a lawyer. He got cancer. He should have died. Came out of it, and he mainly invests in real estate of around 20 units. That's his sweet spot. He has several hundred units. Travels the world full time. He's in his 60s, and he's like Sarah Weaver. Just doesn't have a house and just travels. He's originally from Pennsylvania area, I believe. So Jeff Holst will be a fun one, and he's got a great story. Okay, so tonight I got this pre-approved, Jordan. So you told me this is all accurate what I wrote here. So Jordan didn't write this, just so you guys know. But so everyone, I'd like to welcome you. What promises to be another fantastic evening at the Omaha Real Estate Investors Association. Tonight we're switching gears to dive into the world of taxes. Yes, it can be fun, and especially when you got the right person on board. And speaking of experts, we got the best in the biz right here tonight. He does my personal taxes. Jordan Downey, our go-to guru for all things real estate tax related. Jordan isn't just another speaker. He's particularly part of the furniture around here because he's been here. It's like, what, your 10th time now? Right around. Yeah, you've done this more than anybody else. It's a true statement to his knowledge and his popularity in our group. Jordan is a partner at Frankel. He is the guy that you want in your corner when dealing with amazing taxation, personal finances, business planning, financial reporting. He's a wizard of numbers and has been helping businesses navigate through the complexities of multi-state taxation, international tax compliance, and even the nitty-gritty of business mergers and acquisitions. And let's not forget estate tax planning, a topic as tricky as a Rubik's Cube, but a breeze for good old Jordan. And he's not just a tax whiz, though. Jordan's academic creds are in top notch with degrees from the University of Nebraska Omaha, Master of Science in Taxation from Golden State University. Plus, he's a voice of wisdom on the UNO Accounting and Advisory Board, a key player in his firm's marketing committee, and a proud member of the, I don't even know what these stand for, just so you know, AICPA and the NSCPA. Talk about wearing many hats. But hey, Jordan isn't all work and no play. He lives the motto, slow and steady wins the race, reminding us all that patience and persistence are key. And when he's not crunching numbers, Jordan dreams of scuba spearfishing and chilling in Ireland for a year. So, pretty cool. And so let's get ready for an evening of talk like no other, filled with insights, laughter, and maybe even a few surprises. Let's give a huge Omaha REIA welcome to the only Jordan Downey.
Hello. Awesome. Ted, thank you so much for the warm welcome. Yeah, I mean, we're going to talk about a topic that I think is pretty fun, honestly. I like to think that I show up to work every day and I enjoy it. And so, I don't know, what's the homage that if you enjoy your work, you're never really working, I suppose. But at the end of the day, I think we can make this a little fun. But I'm going to rely on you guys a little bit. I mean, when I go out and do presentations like this, I really want to hone this to what is going to be most beneficial and useful for all of you. I can talk about a lot of things. I don't think a lot of people want to talk about international tax that much. But if you own a property in Mexico, then maybe, I don't know. But I also want to say I am an accountant, and so when you look at my slides, please don't judge me. I think there's a comedian that I've seen, and he does this skit on what not to do in slides. Too many words and too many animation and changes, and so I don't have a lot of animations. I'm not a marketing wizard. I'm a tax guy. But what I'll try to do is not read from my slides, but if you guys don't ask questions and help guide me a little bit on what's on your mind, then that's what we're going to do. So we'll see if we can make this at least somewhat enjoyable for those of you who made the time to come out here. I know it's cold, but you know, they all got some whiskey back there, so I suppose we can make that work. Ted knows. All right, so before we start, there is something that I do have to say, just a little bit of a disclaimer. You know, we're not attorneys. This advice that you hear is really general information. You should not rely upon it to take any tax positions. You should go speak with a professional because everybody's situation is going to be different. And so we'll try to cover some things kind of broad stroke. We'll get into some specific things, particularly on the real estate side. But, you know, just something to just consider as you go through. Everybody's situation is different. And so if you have some questions on some of your specific things, I might be able to answer it, but I can't promise, considering all the different things that go into tax. You know, there's a lot of gray area, there's a lot of opinions, and so we try to do the best we can. We'll try to provide some guidance, but again, no promises that I can answer every single question in every specific situation as it goes. All right. Any questions? All right. Okay, Ted already talked about me, so we can just. Well, the AICPA, American Institute of Public Accountants, NES, Nebraska Society of Public Accountants. Good. Okay, so there's really like, I'm gonna skip around my slides a little bit, but as we kind of go through this, I think it's important to see a little bit on what's going on, you know, particularly on the individual side, because at the end of the day, like a lot of real estate, particularly on how when we talk about kind of structure and for tax purposes at least, it's all going to pass through to you, and so to your individual tax return, whether you're just have it owned in your own personal name, filing it that way on a Schedule E, or you have it in a partnership, or you're an active real estate individual, so you have an S corp, and it all just flows down to you personally. And so understanding where you're at for individual provision-wise, particularly like tax brackets and different things that you can do on that side, it's just good to know, so you know where basically the rubber meets the road, because everything most likely is going to be passed through to you individually at the end of the day anyways. So we'll kind of start there. We'll go through some deductions for pass-through entities, and some of the things that you can do with real estate just as far as structure-wise and getting that benefit. And then just some other general business things. We'll get into some depreciation and some tactics that we can do there, so strategies on that. And then, you know, obviously the real estate activity stuff, maybe we'll hit if you guys are interested in that. So we'll get there. Okay. No. Okay. So, you know, I put this up here, and honestly, I can send out these slides at some point if you guys would like to just have a reference. But for individuals, like there's been a lot of inflation, so you know the tax brackets have kind of gone up quite a bit. When we're talking about taxes, like there's a lot of planning that goes into this, particularly when you're buying, selling real estate, and going through those activities. I feel that just being efficient with your taxes is the best strategy. So let's pay a little tax at the lower brackets and push deductions in the future years if that is your situation. But don't just offset all of your income if we can handle it, because then you're just offsetting deductions that you could take at higher brackets later. So there's kind of a little bit of a play there in just making sure that you're paying an efficient amount, but using the real estate and other strategies we'll talk about later to get your income to a certain point to where you're comfortable with what those percentage are at the end of the day. And that I think we all know what like standard deduction is and stuff, so we'll just kind of keep going on some of these things. The big thing, we'll kind of talk a little bit about how the things have changed, but something that you just need to be aware of in the future. So back in 2018, there was this Tax Cuts and Jobs Act that went through. Well, those provisions are set to sunset after 2025. So we have 2 more years of that. And so some of the things that you were used to back in 2018, you will see those come back around unless Congress makes changes. So nobody knows what they're going to do. If you do, come talk to me later. I'd like to know. But it's just something you got to be aware of, because when we're talking about real estate, particularly, like a lot of it, and this goes into my kind of motto in a way, but yeah, slow and steady wins the race, meaning it's normally long-term plays that we're looking at. So we need to understand what's going to happen more than just a year or 2 down the road, and trying to see how that's going to affect what you're doing, what your investments look like, and how that's going to progress, and hopefully making money and paying the least amount of tax that you possibly can legally. Okay, so a lot of these are just like individual things. Thank you. Okay. Okay, so for real estate, well, just for like normal planning purposes, I think everybody knows that you can gift. You can gift a certain amount every single year for free. You have no tax obligations, nothing to file. I actually get that question quite a bit. But in 2024, that number is $18,000 per person. So you can gift anybody $18,000. When it comes into real estate, some of the situations that I find come up are like an individual has potentially a child or somebody who is living in one of their rental properties. I've had this question a few times, but as far as like there could be rent gifting that goes on there, or potentially you're helping a child buy a house, how much could you give them, so you kind of know what the amount is. And that's per person. So if you're married, then you both can gift somebody $18,000 each, so $36,000 per year. So it kind of adds up as you go. But there's just something to know, so you know that you don't have to worry about filing anything. There's no gift tax returns. There's nothing like that you have to worry about on those. The question was whether does it matter if they're a relative or not, and it doesn't. You could literally walk down the street and hand somebody $18,000, and there is no tax filing that you need to do for that. Some of these things, I kind of mentioned, like they've been around for a little bit, but I think as far as just planning for maximizing your tax deductions, maximizing or minimizing the amount of tax you owe, I want to throw in a couple reminders, and we'll kind of talk through planning around those. I think there's some really good reminders on some of these. One of these in particular is this pass-through entity deduction. So it is a kind of, they call it QBI, so qualified business income, which is basically think about all the income that comes through when it comes from a business activity. So real estate in general is a real estate activity, unless it's a business activity. So you get on the income a 20% deduction for federal tax purposes. So you have $100,000 of income that comes through, you get a $20,000 deduction right off the cuff, as long as you meet certain thresholds and income limitations and business activity. That's the key. You have to have some sort of business activity to get this deduction. And so there's a few things that go into that, particularly in real estate, because real estate, it's kind of gray in some situations on whether it is a business activity or not. There's a bunch of court cases and stuff that go into that, and we don't need to go there per se. But knowing that the real estate activity itself, just knowing what things to do and what not to do. For example, they've come out and said that triple net leases are not a business activity, and so they wouldn't qualify for this. But there might be certain things that you could do in going through that lease that you potentially could change that. And the devil's in the details. But knowing that that's there, and you could be giving up a 20% federal deduction if you don't go through those provisions and plan for it. I think it's just, it's very important. Nobody wants to give up that 20% deduction if you just ask the right questions or change the situation just a little bit, or the facts, or potentially make an election to do that. As far as we'll start calling it QBI, qualified business income. As far as it goes, the type of entity that you have, it doesn't really matter. You can come through, just a Schedule C that you're running as a sole proprietor, S corporation, or a partnership. The thing that matters is that it's an actual business activity that income is coming from. Now that's just qualifying for the QBI itself, and getting that business income. So the source of it doesn't matter as much right now. So as you're doing your planning, you kind of think about that. But as we'll kind of progress, you'll see the limitations on that could require you to change the type of entity you are based on your facts and circumstances in order to get it, not limit out on certain things. Yeah. So the question was, correct me if I misspeak, does it show up on your S corporation return or on your personal taxes? So it's both. The S corp will show that income, they'll have to report it, but it'll come through on the K1 as kind of an addendum item showing what your qualified business income is from that activity. And so depending on, if you only have one activity in there, so let's just say you just have one rental property, then it'll only have one activity as it passes through to you. Now, if you have multiple activities, then you potentially, depending on grouping elections and all that jazz, you could have multiple schedules showing QBI from each one of those specific activities. So those elections are made at the corporate level, and potentially, depending on your situation, at the individual level as well. Does that answer your question? Okay. Oh, perfect. All right, we're testing us. That's great. So you'll get for QBI, like on your K1, it'll come through, but then you report it. There'll be a whole nother kind of form that you're going to file as well in order to actually calculate what the deduction is. So the K1 will pass through, like, here's your income, here's the wages associated with it, because that's a limiting factor, and here's the UBIA, which is like your adjusted basis in your properties, your assets. And so there's a couple different limitations there that will pass through and will give that kind of character of the gain or of that QBI, and all the limiting factors with it, and then it just kind of reports on your personal return and does the calculations there. Let's see. One of the things that they added that I'd like to point out, particularly because I'm in a room of real estate individuals, there's a provision that was passed through this that there's these specified trade or businesses that don't qualify for this. One of those is professional services, and there's kind of a question on what that means to a degree, and there's different definitions of it. But CPAs, accounting services, legal services, so forth, don't qualify, unfortunately. Or at least they do if you meet certain income limitations. But as for real estate individuals, it was actually specifically excluded from the definition for this, and so you guys have a better lobbyist than we do, apparently. So that is what it is. But good for you. Sure. Thanks. Yeah, these are the type of activities that would. Oh, my apologies. Yeah. Okay, so your question was, as far as the slide here goes, are these the activities that would qualify you for a real estate professional? Yeah. So
are these wow, that's really strong. Are these the type of activities that qualify as a real estate professional, so then you can qualify for the QBI?
Yes,
Okay.
and no. So you'll qualify for the QBI either way, really. These activities will get you to a real estate professional designation. These are kind of like the real estate activities that are more like the active real estate activities versus just like renting out a property.
Gotcha. So if you rent out a property long term, right? So then it's classified as passive. You can still get the QBI, but you won't be listed as a real estate professional.
It doesn't necessarily make you a real estate professional, but we will talk about that here in a bit. So,
thank you.
Perfect. This is again just talking about the specified service trader business. And again, same thing. Okay, so getting into kind of the calculation, just so you understand, but it's 20% of your qualified business income, and so in general, like you can calculate forever. However, they have put limitations on income and different thresholds. So if you are if your income exceeds for 2024, it's 365,000. That's sitting here somewhere, but let's say around 360,000. I'll find that exact number. But there we go. Oh, I was $800 off. I'm fired. Well, okay, so there's your limitations. So basically, the limitations itself, like they only matter like when you hit that limitation. Then you have to go into other qualifying factors that will release more of the deductions. So what happens is, and I'm going to go back to the previous slide. I'll go back in a second, but if you are above those income limitations, then you can still get the QBI deduction, but you have to meet certain thresholds. So you can increase your QBI deduction if your wages are, if you have 50% of your wages will help you get to the QBI deduction. So in very simple terms, like $100,000 of QBI would qualify you for $20,000 of deductions, right? But if you're above the thresholds overall, then you get nothing. But if you have wages of $40,000, 50% of that is $20,000. It would then release that $20,000 deduction, and it works in the same way for the 2.5% of your unadjusted basis of depreciable property. So all that's just saying is take your basis, your cost basis in your property and equipment, and 2.5% of that is your limitation. So like most real estate entities, they don't have wages a lot of the times, and so you would use that because you have basis inside the properties instead of the 50% of the wages. So there's two different ways to kind of release it, and you can use this as a planning tool. I've got an example that I'll show you in a minute. I'm going the wrong direction. Let's just go to the example. All right, we got one taker. If I can get there. It's working now. Okay, I got lots of examples, but there's one specific that I wanted to get to. So I mentioned earlier, entity selection is important when it comes to this. So in an example like this, remember the limitations on if your income is above $364,200. If your income is above that, then you need to start using those limitations. And so think about let's say you're a successful real estate broker, for instance, and your income is pretty high. Well, if you just ran all of your activity through a Schedule C, a sole proprietor, well then you would have no wages, and you likely don't have much for basis in anything, and so you would end up with no deduction whatsoever. Whereas if you changed your entity selection and ran it through an S corporation, paid yourself some wages because you have to have reasonable comp for S corps, then you would actually create an increased limit on what you can use by the wages that you paid yourself, and you get a deduction for that. And so you can, knowing your situation, you can kind of plan for this and know how to navigate that. And it's, you'll kind of, this is going to be a reoccurring theme here, that planning for taxes is very important. You can't, I'll get a lot of calls currently on certain situations where we can do some things, but at the end of the day, it's very difficult to go backwards. You can't retroact a lot of things when it comes to taxes. You have to know in the year and make those decisions then. Another kind of example here where it actually flips to the sole proprietor as the more beneficial situation for QBI deduction. I kind of think we're talking about the planning of all of this, and this is just one provision out of a ton, and so you don't want this to be the main reason you do things. There's other potentially legal ramifications for some of the stuff that you're doing, but this is just on the tax side, the type of structure and how you would end up just in this one situation. And so just something to keep in mind, that you got to take your picture as a whole, and then decide what's your best outcome. How can you structure it in a way that's tolerable to you, both on kind of the legal side, but also on the tax side, and just kind of going through that. So it's just important to take everything into consideration and not just one factor. I'll repeat it. Go ahead.
I was just wondering if you could explain, like, just go through one column and talk about the like abbreviations and the numbers. That would be helpful, please.
Hold on. I think I have a pointer. Oh yeah. Okay. Now you're in trouble. Okay, so just going through this example. So I assume everybody knows what a sole proprietor is, but I'll just explain this. You either run the business through your personal name, have no entity, or you have an LLC that you own 100%, which by default is disregarded. So it just passed through to you personally. So those are the two situations that you'd see in this first column. So you have this business income of 200 grand. As it comes down, you have no wages because this is a pass-through, or sorry, this is a disregarded entity. It's all reported on your Schedule C. There's no corporate entity whatsoever. Your QBI on this is going to be 200 grand. So it's very simple. There's no guaranteed payments because that is a partnership concept, and so it's just very simple on this first column. QBI is 200 grand. 20% of that, you're not limited. You're not above the $364,200. So you don't have to worry about any other limitations. And so your QBI deduction would essentially be $40,000 coming from that. Now this is simplified. It would look a little different on your return. And there are some other limitations, but for the most part, that's what would happen in that situation. And again, you're not paying yourself any wages, so there's no wage limit here. You're not. It doesn't even matter because you're not to the 365,000, so it doesn't come into play. But if you go over to the S corp, so let's just say you're a real estate broker, you elect as an S corp with your LLC. You're doing so to kind of shelter some of the self-employment taxes. You're paying yourself a reasonable wage, so on and so forth. So you get to this point where you have $200,000 of income coming from your activity, but reasonably you're paying yourself $80,000 in wages. So the QBI, the business income, is net 120. So that 120 is what the 20% deduction would be based off of, and then so that's why this is less. The S corporation QBI deduction is less than the sole proprietor. Does that make sense? Perfect. Now again, like this is just one thing. When it comes to like S corporations in real estate, particularly like if you're a broker doing active, if you're doing like flips, something like that, that's active activity. So you would, maybe for tax planning purposes, your net overall tax would actually be less, considering the self-employment taxes that you would pay on this full 200,000 versus only paying it on 80,000. And so okay. So that's, again, just another, it's a good example, but even this situation may not actually result in the lowest tax overall. And so that's why kind of running it all and knowing your full situation will help in making those decisions. Any other questions before we kind of move on to more, let's say, real estate purchase type planning? All right. Can't go back. All right. All right. So it's kind of like what I would say, just the depreciation kind of business provision of what we're going to talk about today. Like obviously everybody knows what depreciation is, and so we just need to kind of plan around the best strategy to take advantage of it. Let's go back even to the conversation earlier when we talked about the Tax Cuts and Jobs Act back in 18. Some of the provisions you see in here really bolstered what you could do for real estate, particularly in the bonus depreciation area. They changed some provisions. They allowed you to do 100%. It can now be used assets and not just new assets, which is what it used to be. Bonus used to be 50%, and you had to have new assets. It couldn't be used. Then they changed it, and pretty much anything that has a class life of 15 years or less, you could use bonus depreciation on. In fact, they changed it to be where you could take 100% bonus depreciation. And so they really allowed the real estate individuals who are investing in buying this to be able to use that to build up, improve properties, get the deductions for it, create more assets and value and jobs and all that. I'm not a politician, so so anyways, so that's kind of like just kind of thinking back to what those provisions were and thinking about where they're going now. Okay, so we just talked about the bonus depreciation and the 100%. Well, that was, started in September of 17. Well, it changed. It's changing now. So we're kind of on this like phase out period. One of my clients like to call it the weaning off of. And so just getting used to not being able to just offset everything with bonus depreciation, which again, going back to utilize, tax utilization, paying some tax, but not zeroing out all the time. Some people maybe took advantage of the bonus depreciation a little bit too much, and now there's not a lot of expenses for them now, particularly, and they don't have 100% bonus depreciation anymore, and so it might become a little painful for a little bit because of those things. So understanding where we're going is very important. So we had 100%. Now in 23, we're down to 80%. 24 will be 60%. Then 40, 20, and 0. It probably, who knows if there's going to be a change to that. But probably nothing's going to happen this next year with the election. But after that, who knows what will happen, depending on the economy and different things that the government wants to incentivize us doing. Maybe remember back in 2012, where they used to pay you to buy a house. Anybody do that? Take advantage of it? We got one. Oh, it's 10. It's just kind of crazy to think about that, particularly where the market's been for the last few years, that they had to pay us to buy a house a decade ago. Just crazy. So anyways, I digress. You might want to talk into the mic there.
Yeah, we're right in the middle of doing a reverse 1031 exchange. The property we purchased, we closed in December. The property we're selling is closing in January. So, and we're going to do cost segregation, bonus depreciation. Now, technically, we still don't own it yet because the intermediary company really won't turn the deed over to us until the sale at the end of the month. So that they technically own the property that we purchased. So is our bonus depreciation, since we signed the purchase agreement and closed on it in January or in December, is our bonus depreciation going to be 80% or is it going to be 60%? Because we purchased in December, but the sale is closing in January.
Okay. So first off, who all here is familiar with the reverse 1031 exchange? Got a handful? Okay. So just explain that real quick. So a reverse 1031 exchange is where, well, a normal 1031 is where you sell your property, you put it into escrow or a qualified intermediary, and then you use the funds to buy the next property. So a reverse 1031 exchange is basically what it sounds like. You're going to buy the property first, then you're going to identify the property you're going to sell it, and then use those funds to then get the property that you originally bought. So there's a trust that goes in there. So like you said, you don't get title to it yet, but it is in service. And this is going to be one of those situations that, due to the specific nature of it, I don't think I can answer that. I would kind of have to go back to some of the rules when it goes into like, well, when was the asset put into service, and when did you put it into service? And so I think you probably have to look at those specific rules on how that would work. Likely, with the trust.
We closed on it December 29th.
Yeah.
So we, basically owned it December 29th.
And it's an active real estate activity. It wasn't like a vacant property that you're going to improve or something along those lines.
Yeah, it's a Burger King and Jimmy John's.
Gotcha.
The triple nets.
Likely it will go under the rules on when it was acquired, but I can't say for sure without doing more research on it. It's always, anytime real estate and determining depreciation, it's always when it was placed in service. So, when you buy it, even if you bought it and it's not actually being used, this is in your situation, but you don't take depreciation on it until you actually put it into service. So think about a normal example of you buy a house and you're renovating it and there's no tenants in it whatsoever until you finish the whole rehab. Well, you're not going to put it into service until you start renting it out, or at least soliciting it to be ready to be rented out. And so it's on that date that matters, not the date that you acquire it. And so there's some specific rules that go to that, but it's when it actually is put into service that matters the most. I'll have to get your name later and see if I can find that answer for you. That seems proper. That it's in service and you got it. However, because of the reverse 1031, I don't know how that would actually play. Okay, so the bonus depreciation, we kind of talked about this, but any asset that has a class life of less than 15% or 15 years, depreciable life of 15 years. And so it's kind of, from what you were talking about with your situation with the reverse 1031 and doing a cost seg and kind of getting all the full benefits of it, it's kind of interesting. So like when you do the cost seg, you are basically carving out all of the assets into all these different class lives, and that's how you determine what qualifies for bonus depreciation. That's what you use those for. There's some other slides on this later, but we might as well just talk about it. And so that's where you get those benefits, and it's when you're going through the cost segregation, like I get this question a lot, like, do you have to do it in the year that you buy it? And you don't, actually. You could strategically plan for the year that you need the deductions and do the cost segregation those years and do what's basically called a accounting method change for depreciation purposes. And so there, yet again, some more planning strategies when it comes around to using bonus depreciation for your benefit. As things kind of phase out for bonus depreciation, I thought it worthy to mention the 179 deduction that has always kind of been around. This, in and of itself, is something that, as far as real estate goes, it's kind of hard to take advantage of for anything that has that's a passive activity. Well, it's almost impossible to, in fact. But if you have an active business, then you potentially could take advantage of 179. So basically, 179 is a little bit different than bonus depreciation, but it allows you to kind of elect how much you want to take on the assets. Bonus is like a class-specific election, where like all of your 5-year assets you have to take bonus on or not. So you elect in or elect out, but it's all of them. 179 is different. You can select assets by asset, the depreciation you want to take on it, and so you can kind of hone in on the amount of depreciation you want to take and control your income in a way. Now, this works if, like, let's say, as far as like real estate goes, there are a lot of like passive investors with rentals. Those are per se passive. They have different rules that come along with it, and one of them with 179 is it's non-corporate lessor rule. Basically means that for 179, if you just have a rental property, you can't take advantage of it. It gets suspended. You have to have a actual operating business to actually use it. So if you want to take it on a building, 179, you have to have an operating business that's running that building and owning it. So think more like manufacturing companies and stuff like that. So for passive real estate, it's not really something that you can use. But if you have, if you're more or less like a real estate broker, or you have some equipment or something like those, you potentially could use it in your active business for those types of assets. So cars, equipment, stuff like that. Here's kind of your automobile limitations. One of the big changes for 2023, there wasn't a lot of changes in the tax law between 2018 and now, other than all of these COVID relief things that came through. And so there's a bunch of different credits and things that went through there, but for the most part, the underlying didn't really change much. But through the COVID relief, they allowed you to take 100% your meals and entertainment for 2 years, and you no longer get that anymore. It's really just meals, 100% meals. But so now it's back for 2023, where you get a 50% limitation on those expenses. So just something to be aware of. Yeah, exactly. All right, on to some more real estate specifics. So real estate, particularly rentals, really the amount of activity they put in it matters. And there's a lot of different provisions in here on this. I think everybody knows the term real estate professional. But when you dive down into it, real estate professionals is just somebody who is so active in real estate activities, which we looked at a slide earlier which showed those activities. You're just involved in those activities so much that you meet the thresholds of the hours requirements and not working in other stuff more than you do real estate. And so those sort of things are what matter when we're talking about passive activity and active, and just something that you need to be aware of when you're looking at your real estate. Now, not everybody has is a full-time real estate individual. Like you may have a JOB, W-2 income coming through. Those sort of activities, if you have it, the laws are essentially set up for real estate that you can't be a real estate professional in those situations, just because you can't spend enough time in real estate to meet the rules and work more than you are at your job. And even in those cases that you think you might, if you work at a full-time job, I guarantee you won't meet the requirements. And so those things is just something to be aware of, and questions that I get asked quite a bit. But there are certain planning strategies that come into this. With real estate, if you're passive, you're not a real estate professional, you have some limitations that come along with it. There are a couple of exceptions on it, and one of them kind of listed right here is this $25,000 loss limitation. Gosh, there's a K behind that, so it makes it look like it's 25 million. I assure you it is not. But basically, if your income is between 100 and 150,000, then the losses that you potentially could sustain in real estate that is passive, then you can use that against your income. And so, particularly in like new investors and younger individuals, maybe newer in their career, some of the planning I've done with this with individuals is knowing where their income is and how much losses they have that they could basically harvest through their real estate to drive their income down as much as possible in other ways. So think about IRA contributions, maxing out your 401ks, stuff like that you could drive your income down to. This is your taxable income, your adjusted gross income. You can drive it down using some of those factors, and then you release these losses that you can take in, which will decrease your income even more. And it usually, a lot of times, it works out really nice in some of those newer investors whose potential W-2, isn't that high yet. Then you can really use those tools to kind of drive your income and make sure that you're getting to take advantage of these and not just letting them sit there, because all of those losses that will come through that you can't utilize potentially, they don't go away. They just sit there. They're just suspended. Something you can use in the future. They'll roll forward indefinitely until you can use them. But it's just something like if you can plan your income, know what your income is, and use it, then you potentially get your income down to certain levels to use that. This is one of those like slides where you're like, oh my gosh, why? This is just some of the rules when it comes to participation, what material participation is. It's hours requirements. It's not working more in one thing than another. Being active in the real estate means that nobody else is more active than you potentially. So there are a number of different factors, and these are all basically taken straight from the IRS website, just for reference. But a lot of them are very specific, and so you just kind of have to know what your situation is. Oh, we have a question. Don't yell at me for my bad slides, please.
Sorry. So it sounds to me like a lot of people in this room would qualify for this, but how do we know? Like, do we call you? Do we call someone else?
I mean, potentially, you probably should call me in January and not December if you want to. But a lot of the times, it really should be, you should track it. So you need to know how much you're putting into your activities. And so you almost, unless you're just a shoe-in for a real estate professional, you really need to track what's going on and where you're putting your time, because that's going to determine how active you are, and particularly not just like tracking your time, but tracking what you're doing. And there's some really nifty apps out there that you could use, almost like a timekeeper for yourself. And so those are the things that I would suggest doing if you're not, if you're not in real estate constantly, and you need to know what activities you're putting your time into to kind of help dictate that decision.
Does this meeting count?
I would say maybe. I'd say 51%. Yeah. Yeah, you're networking, your marketing, because at some point you're going to talk about real estate and try to find new properties. The interesting thing on just like that question, particularly like how gray it is in a way, depending on how you identify where your time is. For some people, this could just be, I'm out looking for new properties, which is more of like, it's more of an investment activity than a real estate activity. So driving around or looking at Zillow aren't necessarily going to give you active real estate participation. I don't make the rules. Okay, so here's your real estate professional. 750 hours. You need to meet that. You also need to spend more than 50% of your time in the real estate activities. And again, it can't be investment activities. So don't, like, if you're looking for properties constantly and you buy it and it's out of state, you're like, really, it doesn't really count. But the time you spend on walking through properties and negotiating leases and monitoring improvements that are going on, doing the improvements yourself, those all would qualify. And there's always this as far as a tip goes, if you're married, only one of you has to actually qualify for it. And so, if you're not married, maybe go find a real estate professional, I suppose. I don't know. You're in a good spot, good place, good people. A lot of real estate professionals. I don't know. Ted's the matchmaker. That's not. All right. Any other questions on that? Active participation, material participation, real estate professional. That's. I would add one last thing. When you are looking at your real estate activity, one of the important things you do and things that kind of happen potentially in the background that you should be aware of, the elections that you make to group your activity are important. So if you have, 75 properties and you spend 10 hours on each, you're obviously not a real estate professional if you count each of those activities individually. But if you group them all together, then you meet the 750-hour requirement, assuming you have nothing else going on, then bada bing, bada boom, you make it. And so the elections on your return, and I suppose having somebody who knows those things is helpful to make sure that you're covered when it comes to taking that real estate professional designation, position, and just making sure that it is legit. So there's your tracking mechanisms, and then some other elections that need to be made, particularly if you have multiple real estate activities, and we need to pool those hours together. I get a lot of questions on short-term rentals. Um, Anybody using short-term rentals? I assume there's a bunch. So there, as far as like treating those, this is one of those areas that does get a little gray. So we'll talk about it, but it's going to be a fact pattern that you got to figure out with your professional on what fits best for you. But really, like the crux of the issue is most of the time real estate in and of itself is going to be reported on as Schedule E or 8825 if it's in a partnership. And so that activity, as it passes through, it's going to be classified as per se passive. It's going to run through, and if you're not a real estate professional, then it's going to always be passive. Well, if you have short-term rentals, it kind of changes the equation a little bit on where it's reported. Now, even though this may be reported differently, it doesn't necessarily mean that you're an active participant and get the active rules for that and are able to deduct it and not be limited to those losses on passive activities. But instead of, let's say on short-term rentals, what you'll find, depending on how much activity you have on there and what they call it, substantial services you provide. So if you have real estate activity and it was a long-term rental and then you start Airbnb-ing it for 3-4 days at a time, less than 7 on average, then you potentially will have an activity that is not reported on the normal rental real estate activity forms. Now they are reported on a Schedule C, or I guess box 1 of your K1 for partnerships. But so it changes where it's reported if you have short-term rentals, but it depends on how much activity you're putting into it. So I've always kind of talked about if all you're doing is just providing a place, for those days, but you don't do anything else, like they come, they leave, you change the linens, and you're not doing anything else, that gets really gray on how you would actually report it on a Schedule C or on an E for normal rentals. Normally, if you think about short-term rentals, you think about hotels for the most part, where they're providing food, entertainment, travel. They're obviously doing the linens and cleaning and doing all those things. They're providing substantial services for that. Now, unfortunately, there's no real guide on when you meet that threshold and go over. It just kind of is defined as when you provide substantial services. Well, what are substantial services? And when do you meet it? Well, facts and circumstances, people. It could be pretty gray on that, on where you report it. But in the day, the strategy on this would be to meet those thresholds, change it to active. So it's reported on a Schedule C. Now, even though you're not a real estate professional, you're still able to kind of utilize those losses without being a real estate professional. And if you meet the hours requirements for being active on that, then it does change how things would be treated on your return. So that's one of those strategies that you kind of see, and I kind of see on, I have clients who send me TikTok videos. And so it's well, what do we think about this one? And so that's something that you'll see kind of reoccurring, those questions well, how do we actually do this? And that's kind of where it is. You need short-term, and you need to provide substantial services with that short-term. So that's kind of the reason why you would do it, to get it out of the per se passive rules and into different rules. You still have the passive issues potentially, but the threshold could be a lot lower than it would be for a real estate professional designation. I kind of thought this was just a nifty little like guide, and I'll probably just have to send these out because it's a horrible. But basically, it's just kind of going down a decision tree on do you report this on a Schedule E or Schedule C. Kind of helps in just knowing that, but again, it comes down to substantial services, and so that's let's see. So I like to cover this a little bit, particularly with some of my new investors. Entity selection when it comes to real estate. Again, there's a lot of other things that go into this, but in general, when you have real estate, you don't want to put that type of asset that you're going to be depreciating and potentially creating losses inside a corporation, an S corporation or C corporation, and there are specific reasons for that. I'm going to name two off the cuff. So when you create losses, you have to have basis in order to take the losses. How do you have basis? Well, when you buy something, you get basis for the cash that you pay for it, but you potentially get debt basis as well. Debt basis, the loan on the property would actually count as basis for yourself. If you put it into an S corporation, you contribute cash to the S corp, you're still personally guaranteeing that asset. You don't get debt basis in that situation. So you would only have basis for the amount of cash that you put into it. So if you create a big loss and it is inside an S corporation, well, it gets suspended at the S corp level and does not come through to you. It's a basis limitation because you don't get debt basis as it flows through the S corporation. Now, if you own the real estate yourself or you own it through a partnership, an LLC, that does not have the same treatment. So understanding what you're going to use the entity for, you're buying real estate to hold, it is almost never something that you would put inside of a corporation like that. And so, and that's one of the big reasons, because you will get basis limited on any losses that would come through. The other reason is transferring assets around in a corporation. Anytime you basically move an asset from a corporation to a different corporation or to your personal name or pretty much anywhere outside of that corporation, it's very rigid. Anytime you do that, you're going to trigger gain, essentially. And so if you have it in your personal name, you can transfer it over to this LLC over here. Or if you have it in a partnership, you potentially could distribute it from that partnership and bring it back to yourself. There are a lot of different rules to it, but doing those things doesn't necessarily trigger gain like it would in an S corporation. So just something to consider when you think about how am I going to put this asset into an entity for not an attorney, but potentially legal protections or structure and stuff like that. So, but those are like the two big reasons on why putting real estate inside of corporations is not something that you want to do. Any questions?
Hey, Jordan, when you're reviewing somebody's taxes, specifically a new client, what's a common thing that you find is a mistake that other tax accountants make when working with real estate investors that you guys find and rectify?
Well, rectifying it is not as easy as finding it, I would say. But when I will see like some that that do put it into entity structures that they really shouldn't, or potentially
like rentals and S corps.
Pretty much. I mean that it's more common, I think, but I also see it inside corporations. I've seen people move them around and they didn't trigger the gain. Like, so this is one of those taxes like self-reporting for the most part until you're caught. Well, they didn't even know they were making the mistakes, but like partially because they weren't communicating with their accountant at the time that they were doing it, or maybe they did it after the fact and their accountant didn't notice. Hard to imagine, but sometimes it just happens. But those are kind of some of the common things that I see. And then you'll see other things like they'll take improper lives on depreciation if they shouldn't, or they won't follow the capitalization policies that they put into place. Things like that kind of see pretty often. But then it's just taking advantage of different entity structures that I see quite a bit. So you could have active activity and doing all of the right things, but never made an S selection in order to help yourself get additional QBI deductions, pay yourself a wage so you're not a reasonable wage so you're not paying self-employment tax on every dollar earned from those entities. Some of the simple stuff, like you'd be just surprised that other accountants aren't looking at those and making those suggestions. Also see situations where you'll get advice on potentially selling something, and maybe they didn't tell you that you could do a 1031, or maybe they told you to do 1031, but you look at it and you're like, oh my gosh, like if you would have done the math, it actually would have worked out better if you didn't. Those are the things that I'll come across, and really a lot of it's just communication and somebody just being a little bit, you don't have to be a lot, but a little bit proactive on a few things could really go a long way.
I also find that when I get talking to a lot of new investors, they don't really understand capital gains, and they start doing a whole bunch of new flips. And so what's the best way to minimize that impact?
Well, first off, knowing what your gain would be if you sold. And so a lot of people just, maybe they don't track it or track the basis as well as they should, or they just didn't ask and they just move forward without. And so really just, again, it just comes down to planning a little bit. Usually your accountant should have, a depreciation schedule they can look at and be like, okay, well, if that's where you're at, roundabout, this is what your gain would be, and then therefore this is what your tax is. It's not that difficult to calculate if it's tracked and the questions asked. But I say more or less when people that I find come over, like it's a lot of just keeping track of things. It's really, you sell a property in January, and you haven't, you didn't provide the information to your accountant, and then all of a sudden, next January comes around, and you're like, oh, what happened? What happened last January? What happened to this? Why didn't you tell me? Why didn't you track it? Or just kind of understanding where your deductions are. A lot of people might just run things through 100 different accounts and credit cards and not know where anything's at. Well, if we can't track it, then there's potentially you'll be paying more tax and more gain than you should otherwise. And so those are just some of the things that I see and try to get ahead on. But I'll be honest, like particularly with like clients I like to work with, like you got to put a little bit on yourself, because you're the business owner, you're the one who's making the decisions. You should know where your numbers are, at least have a pretty good idea. And so a lot of that's just having the pulse of where you're at with your investments. And so I think it's important for them to be in the weeds a little bit, maybe not all the way, depending on how much activity you have, but at least understand how it's tracking and where you're at in those investments, and whether they're short-term holds or long-term holds, but knowing where your gains at and cash flow, and not just kind of going with it, is very important. We kind of touch base on like-kind exchanges. When I talk about this, there are just a few provisions that you just need to be aware of, but the key thing is it's an exchange. It's not a sell and buy. So you do have to use a qualified intermediary to do these things. But after you've checked that box, you need to make sure that whatever asset you're buying is at least the same or more for the fair market value of what that asset that you're selling is. And so you sell something for 500 grand and you buy something for 400 grand. Well, that change there is going to be looked at as gain, and it comes off the top. So when you go through that and you're looking at 1031, the key is if you want to defer everything and that works for your strategy, well, the asset that you are acquiring needs to be at least the same amount as the asset that you're selling if you want to get full deferral on it. And let's be honest, like, as far as the 1031 goes, like it's a tax-free exchange, but we're talking about deferring. It's a deferral of the taxes until another time. And so just because it doesn't trigger now doesn't mean it doesn't go away necessarily.
How do you figure out how much of that, like off the boot, you're going to have to pay? Is it your normal capital gains rate, or how does that work? I haven't got to that situation, but I'm probably about to. So,
Okay. I mean, it is capital gains rate as long as you don't have recapture, but you can't. Well, it is capital gains rate, but the amount could change. Like recapture, and this maybe goes into a little bit of the 1031 itself, but you can only defer capital gains. You can't defer ordinary income, and so that's why there's kind of a provision in here. There are very minimal exceptions to this. You need to hold the asset for a year and a day before you would do your exchange. Otherwise, it wouldn't qualify. Yeah.
we have 4 that we're currently in the process of, and one of them is probably going to fall into that.
Yeah.
So I was trying to figure out with the boot how much of it, how bad I was going to get beat or not, or what to be prepared for.
Well, keep in mind that like with 1031s, it doesn't have to be for one property for another property. Like, you can have one property you sell. You can identify 3 properties.
Right.
And you can identify more than 3, but there's specific like values you have to apply to each one when you do it. So it's not just like a blanket.
Right.
And so there are some other provisions there that can help potentially.
Right on. Thanks, man.
Yeah. All right. So the other thing at 1031s, and I kind of mentioned this a minute ago, but know your situation. I've seen this quite a few times. Ted asked the question earlier, like, what are the things that you see with clients? With new ones in particular, like, I've seen these 1031s that go through, but then when you look at the numbers and what their gain is and the new property they're buying, it was like they would have been much better off just selling the property, recognizing the gain, getting the new property and depreciating that and taking the losses from there to offset. And even if your income potentially is a little bit higher because you do that, you might actually find that the losses that are coming over from the real estate that you purchased, those are ordinary. Whereas the gain from the sale is capital. So the ordinary losses that come through are going to offset your other ordinary gain. So then you're just going to have a higher capital gain. Well, don't quote me on the number, but if you have capital gain income up to about 85,000, 84,000, is 0% tax. And so depending on where your income lies in that parameters, you potentially have 0% tax on some of that, even though your income is high, it wouldn't matter. And so just know your situation, because I've seen it quite a bit where it actually resulted in a worse off situation than if they would have just sold the property, not gone through the hoops, recognized gain, and bought the next property. We did mention this a little bit. So cost segregations, those are the whole parameter around this is you're just taking an asset that you normally would buy, which would be land and building, which is either going to be 27 and a half years for the whole thing or 39 years depending on commercial or residential. But you're taking those asset classes and then you're dividing it out, carving it out into all these different specific assets for what they are. So think about, you have the building, but then you also have a parking garage, or a parking lot. You have the roof of the building, and you have the utilities that go into the building, and the plumbing, and the electrical. Like, everything can be carved out and potentially have a lower life, which will give you, this is the reason they do it, will give you the ability to bonus depreciate those assets or just depreciate them over a shorter period of time. And so it's not that you get more deductions overall, it's that you get more deductions now versus down the road.
Every time you talk to somebody about this, the answer is always different. Like, I've heard, like, oh, only do this if the property's $1 million. Then I've heard people doing it on small multis. I've heard people doing it on single families. So what's the real answer here?
Well, you got to know your numbers, one, and you got to understand that in order to do a cost segregation, it costs, right? And so depending on how much that expense is, sometimes it could be 6, 10, 12 grand, depends on how big the property is. But you got to have enough benefit now that it makes sense for you to do that cost segregation. And there are right and wrong ways to do cost segregations. So understanding the company that you're working with and does their process stand up under audit is important. So you want to make sure you have a reputable cost segregation firm that's going to stand behind their work and defend you if there ever is a question.
So I have a 5-unit that I do all Airbnbs on in midterms, and that property is worth $500,000. Is that worth doing a cost seg on?
Well, understanding what you went through with that, I know that you have the detail of the expenses that you put into that property, right?
Yeah, it should have been condemned when I bought it.
Yeah. So it's a good example of, like, your situation matters. If you would have gone in and just bought the property, then potentially a cost segregation would make sense, that we would do that. It's $500,000. You make sure you get the right place. Will stand behind your work and does the process correctly. Then yeah, it could make sense for you. You have all the expenses on everything you put into that entity or to that building. So we know how much you put in flooring. We know how much you put into the cabinetry. We know how much you put into all these different things, and that in and of itself gives us the ability to almost, I'd say, do a mini cost segregation where we know where the expenses are. Now, we're not going to take full, we'll follow our capitalization policy on it, but we're going to capitalize those things, but we could get a much better benefit because we know exactly where they're at. You don't even necessarily have to go the extra mile on that. So that's kind of, but it's, again, you got to track your stuff. You got to know where they're at. You got to do a lot of things in order to get to that point. And so, particularly if you're buying a house that's essentially condemned, like, you're going to have a lot of expenses, remodel and demo and all that other stuff. So you just have to track it. Let's see. Okay, so we're kind of to the end here, and there's just two quick things that I was going to mention. On the cost segregation. So there's one more reason on doing this, and just something to be aware of. So there is. Oh, here we are. So okay. So cost segregations, when you know every single facet of the building and how it carves out and what your cost is, you could do something that's called a partial disposition. Now, this is kind of technical in a way, but basically, let's say you buy a property, you do the cost seg so you know how much the roof cost you overall on the property. 5 years later, the roof gets destroyed, something happens, insurance doesn't cover it and whatnot, so you got to replace it on your own. Well, the partial disposition will allow you to basically carve that piece out of what you originally purchased and expense it, and then the new one that you put on, you then capitalize the new one. So you're able to basically get an expense for whatever cost is left on that roof. So if it was 5 years later, well, you had 22 years left of depreciation on it, that if you didn't have the cost seg and be able to carve that out, you wouldn't be able to do it. But you, in this situation, because you had the cost seg, you could carve that out and do a partial disposition in order to take that expense, and then you'll capitalize the new roof into it. And so just another kind of planning strategy that you would use when thinking about whether to do a cost seg or not. It will give you some planning down the road potentially as well. All right. Okay, so I want to mention one thing. I don't have a slide on this, but Nebraska has changed a rule and kind of adopted what a lot of the other states are doing. It's called the pass-through entity tax deduction. So think back to the law changes back in 2018 that limited the amount of state income taxes that you can deduct. So think the state and local taxes, like real estate, income taxes, sales and use taxes. They limited it to 10 grand. Well, a lot of other states, and this has kind of gone through the Supreme Court, and they've ruled on it, so there's a way that they've set this up. So basically what happens is you can take a deduction for your pass-through income, and it has to be pass-through income. So it has to come from a partnership, an S corporation. That income that passes through, you can calculate on your tax return how much of a deduction the taxes would have been for Nebraska, how much the taxes would be for Nebraska. You pay those taxes at the level of that entity, either partnership or S corp, and then you get a credit for those on your personal return for paying those, along with the deduction that you receive at the entity level. So you get to deduct those, and they're no longer limited to the $10,000 max. Okay. Not only can you do that, but Nebraska has said that you can do 2023 and on, but we also are allowing you to do 2018 through 2022. So you can file an election, run the calc, pay the tax for Nebraska to Nebraska through the elections, and then get a deduction for it on the business side, and get a full refund for the dollars that you submitted to Nebraska as a result, because you've already paid that tax. Now you're paying it through your entity and then getting a credit and a refund from Nebraska on your individual return. So that's just something new that came out in the last month or so. It took Nebraska quite a while to kind of set up the process on that and everything. But for the 28 to 22, if you have a pass-through entity, it's something you should be thinking about, talking about with your accountant, and seeing if it's something that would work for you. And you have 3 years to do it, to go back. Pass-through entity tax, PTET, you'll see. Iowa has a similar thing as well, but theirs is a little bit different. They only let you go back 1 year, and instead of a simple form or stuff, you actually have to amend your personal return. So, but it's kind of reiterates, like, everybody's situation is different, and there's a lot of other states that are doing this as well, and none of them have the same rules that Iowa and Nebraska have. So everything is different on the state level, and so just make sure you have somebody who's looking out for you on that if you have investments in different states. Okay. Iowa made the change. And so, but you can only, for Nebraska, they let you go back 2018 to current. You could pay basically back taxes essentially and get refunds and deductions for it now. Iowa only lets you go back 1 year, but you still get to go forward. So, and the rules will change again in 2026, so you can do this through 2025 currently, and then we'll see what happens. The question is are we as CPAs doing the beneficial ownership disclosure with FinCEN? It's a new provision that came out. It's basically you have to report what your ownership is in your entities, any LLC, corporation, whatnot. And the answer is no. That actually is kind of ruled on and designated as a legal filing and not under the tax rules that allow us CPAs to operate. And so, no. But I think and the process really is quite unclear right now, but basically FinCEN.gov has some resources on there you potentially could find to kind of help out. And I believe that if you had an entity that was formed before November of 23, you have until the end of 24, 12/31/24 to actually do the filing. If you started an entity in November, December, then you have until the end of January. And that's important, so make sure you don't miss that. Any other questions?
What do you think is an adequate amount of like time to get to know a client as far as like for tax planning? We do a lot of transactions in a lot of different businesses, and I feel like my guy always just wants to do something in October, and I don't know that that's really adequate amount of time to understand our situation.
Sure. Well, I mean, it's going to come back to how much activity you have going on. But what I like to tell my clients is I'm not a tax season only accountant. So I'm here year round. So you got to keep me in the loop on what's going on. And so any sort of business decision you're making or any kind of planning item you may have or if something changes in your business, then we should talk about it. And particularly in some of these situations where you're paying quarterly, you might want to make adjustments to that depending on the entity structure. And so I would say for some, that could be enough. Going through tax season, you're obviously talking through April and getting everything done, and then talking again in the fall, kind of see where things land, if there's anything else you need to do. But I think we do in all honesty, we do a pretty good job of getting out information to our clients when things change, like this beneficial ownership thing. That came out a couple months ago, and we were pretty quick to provide some information. It's like, hey, this is what you need to be aware of, and I'm sorry, this isn't something that we can help you with, and so you need to talk to your attorney and kind of go through that. But those are the things we try to stay ahead of, and that's more or less the difference between a CPA and a proactive CPA, I suppose, or accountant. I don't know. Being proactive in planning, but I'll go back to that for the most part, and that's one of the most important things. So it could be enough, but it's gray.
I was wondering if you would talk about the de minimis safe harbor election. It's for those of us who do our own taxes. It's something that doesn't seem to come up anywhere. It doesn't seem to come up in these presentations. And when we buy a lot of small items, small as in appliances, things of that nature for rentals, it's very important. And I was the fool that was still depreciating a used stove as of 2 years ago until I discovered it. So, but somebody here might benefit from that explanation.
Yeah. No, thank you for asking a question. So, every entity has a capitalization policy, and the IRS has come out and said if you want to elect the de minimis election, then you can elect to expense anything that's $2,500 or below on a per item basis. It's an election you make on your tax return basically every single year, but it allows you to expense a $2,000 fridge because it's under that limit. That's all that matters, as long as you're making those elections. So your depreciation would be lower, your repairs expenses would be higher. So there are some things to kind of think about there as far as how potentially banks might look at it, or what you're trying to accomplish. And so, but yeah, anything under 2,500, it's a really nice thing that the IRS did, which is rare. No, not that I know of. I'm sorry. Question was, is that something that's indexed for inflation, that 2,500 de minimis? And the answer is not that I'm aware of. Unfortunately. There's a lot of provisions that aren't indexed, unfortunately. So, awesome. Any other questions? If not, yep, I'll be around.
So we're going to wrap up here with the drawing. So if you didn't put your name in the drawing bucket there for the 2 books, please do. But first off, any visitors tonight? First time members? It was always good to know. Yeah, you came to a luncheon once, yeah. Your first event, yeah, so that counts. There we go. Well, welcome. Thanks for coming. And we always like to open up the floor. If anybody has anything they're looking for in their business or wants to shout out their business, any questions you have in general, the mic is yours if anybody has one of those. Making my life really easy tonight. And so I want to just conclude with a couple things. Thanks to the people that came to our holiday party. We did that. It was the first one we've ever done. I think we had a pretty good turnout. I remember 50 plus people showed up. So thank you for that. And who were sober enough to drive home was even better. And thanks to DVG for sponsoring drinks afterwards, and Liquid Lending for sponsoring our event tonight. If you get a chance, you're encouraged to take care of the staff. In this case, give them a review, throw their name, Jenny and Kelly, in that. They really appreciate that. They do a lot of hard work for us. They will be taking care of us when we go over to Burger Theory next door. And if you guys have any questions for me, feel free to grab me. I'll be there also. But thank you so much, and thanks for coming out in this weather. I know that kind of kills it on the weather, and we had also, this is the second Tuesday, so it's not our normal event, but I think it would have been worse if we did it on January 2nd. So, but thank you guys. Have a great night. Appreciate you. Oh, ugly sweater. We gave away a whole bunch of stuff. Oh, I got these books to give away. So, oh man, there's one card in here. Scott Weaver.